Good afternoon. I'm Mary Beth Vitale, and I'll be the moderator for this very timely webinar on ISS, tax reform, and pay ratio. It's the Compensation Committee's 2018 checklist. Although we are winding down 2017, and I'm sure some of you are still doing holiday shopping, our board committee agendas are already looking full for the first quarter of the new year. We have a significant new disclosure mandate coming into play with the CEO pay ratio, and pending legislation on tax reform could shake things up considerably. There is also recent guidance from the proxy advisory firms on what new criteria they'll be watching for in 2018. To help us understand and prioritize these issues, we're joined by two executive compensation experts from Pearl Meyer's New York office, Deb Lefshe, a managing director and attorney with the firm, and Sharon Paduska, who is a principal with the firm and a compensation communications specialist. Before we get started, Deanna Breen with NACD's education team will cover a few housekeeping announcements.
Thank you, Mary Beth. Before we begin, I will go over a few housekeeping items, and then I will turn it back over to Mary Beth to go over the agenda. On the right-hand side of your console, you should see several boxes. At the top, you can submit a question to be answered by our speakers during the program, time permitting. Please note that if you submit a question, you will be opted in to receive future executive compensation thought leadership from Pearl Meyer. In the middle, you can tweet live with us using @NACD and @Pearl Meyer. And at the bottom, you can download a copy of today's slide deck and access additional resources. Today's presentation slides are also available to download at the link on your screen. You will automatically receive one NACD skill-specific credit for your participation in this webinar of at least 30 minutes. Credit may be applied to NACD fellowship programs, and you can contact fellowships@nacdonline.org for more details. Just as a reminder, a recording of this webinar and a copy of the slide deck will be available early next week at nacdonline.org/webinars. Finally, we will have a few evaluation questions at the very end of the program, and we would appreciate your feedback, so please stick around after the last few slides to answer those questions. And now I'm going to turn it back over to Mary Beth, who will go over the agenda.
Okay, I wanted to just talk to you. The first item is going to be tax reform, which I'm sure everyone is just waiting to see what exactly will happen. So Deb is going to give you the current status and potential impacts on compensation. Sharon will then talk about CEO pay ratio, because 2018, it's here now, so we need to address that in our proxies coming up. And then lastly, Deb will come back on and talk about ISS and Glass Lewis's proxy voting guidelines. And they have definitely updated new items and what's going to be released for 2018. So I'm going to turn it over to Deb to talk about tax bills and compensation. Deb?
Thank you, Mary Beth, and good afternoon, everybody. As you all know, unless you've been hiding from it, we will all be subject to huge changes under the most sweeping tax overhaul that we've had in many years. This has been sort of up-to-the-minute planning and looking at the different proposals in the House and the Senate, and it's been going back and forth for at least a few months. But as of last night, we understand that the Republican leaders have reached a consensus in principle on the final tax bill. We haven't seen it yet, but the text of the final bill should be unveiled tomorrow. It's anticipated that it will be voted upon by the House and the Senate next week, although they're fighting about who's going to go first because there's never a dull moment. And then the President is expected to sign it into law before Christmas. So we're on a fast track, and it's been changing so rapidly that even the deck that we put together maybe a couple of days ago is already outdated. So we'll start talking about some of the things that have happened and some of the things that compensation committees are looking at now that we're pretty certain what it's going to look like in final form. At the 10,000-foot level, what are the big things that are happening under the tax law before we drill down into executive compensation? 1st, this tax bill will go into effect imminently. It's going to be applicable with respect to money and revenues in 2018, although the reporting of it and the paying of it for calendar year taxpayers, they won't see it until 2019 when their returns are filed, which is not ironically after the midterm elections. One of the biggest changes is that the corporate tax rate is significantly lowered from 35% to 21%. The top individual tax rates will be lowered from about 39.6% to 37%. There's elimination of the alternative minimum tax. And what's been a very hot topic, particularly for those of us located in New York, New Jersey, and California, and states with high state taxes, is the bill was going back and forth between complete elimination of these deductions of state and local taxes. Under current laws, taxpayers can deduct property and income taxes paid at the state and local level from their federal taxable income. At one point, this entire deduction was eliminated, and last night, I understand in reconciliation, we now have confirmation at the final GOP the deduction will be retained but limited to $10,000. So that's sort of the high level of activity and where things panned out. And one other thing that we are not dealing with directly, but there's been a lot of talk about the taxation of carried interest, which both candidates in the last election had proposed to eliminate, and that really gave a big benefit to investors such as hedge fund managers who would get the benefit of corporate capital gains instead of income tax when they made certain investments. That was not, our understanding is that has not been eliminated, but now these investors must hold the investments for 3 years in order to get the cap gains rates rather than the income tax rates, which may not even matter anymore since the deductions and the income taxes have come down somewhat. But when we talk about what we're looking at here as executive compensation professionals and how it drills down and we go into the weeds on named executive officers, which is what many of us focus on, either helping consult on how to provide this money to our named executive, our proxy officers, or if you're a director on the board, how it will impact what we're doing and the compensation we're providing. And that really comes down to our old friend, Section 162M of the Internal Revenue Code. That has been in place for approximately 23 years. It was put into place to address issues of excessive executive compensation, and ironically, compensation got more excessive afterwards because everybody tried to figure out a way to get around 162M. Just by way of background, under Section 1, under the tax code generally, companies may take a deduction for expenses. Expenses include things such as compensation. What 162M did was limit the corporate deduction with respect to executive compensation for compensation payable to those officers listed in the proxy statement, generally the CEO, the CFO, and the next 3 highest paid executives. And it limited the deduction such that everybody could take up to $1 million on the deduction, but anything over $1 million would be non-deductible except to the extent it fit in certain exceptions. And one of the exceptions, which is a big one, which is the one we all focus on, is the performance-based exception. And so what makes pay performance-based? Well, you'd have to jump through a bunch of hoops to get there, and companies figured out in the past 23 years a bunch of creative ways to get around to meet this exception. For one thing, any kind of measure that pay is based on must be put to shareholders and voted on in a plan. You must have independent compensation committee members approving the measures every year within the first 3 months, generally, of the year. At the end of the year, the compensation committee members must certify that the measures have been met, and only then can you pay out amounts over $1 million that will also be non-deductible. And companies, as I mentioned, spent a lot of time and money and effort formulating their plans to meet this deduction so the deduction would not be lost. Well, here we are in 2017, 2018, and both the House both the House and Senate bills have contained virtual evisceration of the exception for performance-based pay. So really what that means is most companies will now they'll have a limit on the deduction, and it will only be up to $1 million. Moreover, back in 2007, the chief financial officer fell out of the 162M equation as a result of a technicality merging the new disclosure rules in 2007 with the literal wording of the tax code. So for many years, the CFO has not been subject to the loss of deduction. The CFO is now back in the formula. Another tactical way we used to get around 162M caps is 162M was only applicable to the named executive officers who were in the proxy at the end of the year. So we would get into some creative timing of payments so that payments would come after that person was no longer reported in the compensation the summary compensation table. Well, I guess the lawmakers figured that one out, and they said now, once an NEO, always an NEO. So no matter when this payment is paid out, the company will lose a deduction over $1 million on anyone who was ever an NEO. So lots of big hits on the loss of deduction for 162M.
Deb, I have a question for you. Would this mean if it does pass, or in the potential of it passing, should CFOs try to reserve the amount of bonuses that they would have paid out in 2018 but take the hit in 2017 because of the reduction in the tax rate and this 162? Hopefully I'm not confusing the two issues, but I'm just wondering if they should start looking at that potential if it's signed.
Yeah, I mean, and that's a great question, Mary Beth, and I do plan to get into that. You know, what can we do now that we know that this is happening, or 99% that it's going to happen? What does that mean to us, and how can we plan for it?
Okay, good.
So, of course, the silver lining in all of this is everything works together. And so now we have corporate tax rates coming down. They're going from 35 to 21, and as a result, the loss of the deduction won't be as severe. You'll still have a loss, but the loss isn't going to be as painful as it had been with the higher tax rates. The other question that comes up is, well, now that I don't have to I don't have to conform to 162M and all the draconian rules surrounding about how I pay, and is everything going to turn into one big discretionary free-for-all? And am I going to now be able to pay whatever I want, whenever I want? I don't have to have a written plan. I don't have to have committee approval. And the answer is probably not. I mean, you still have governance issues, and you still have pay for performance, philosophies that you really should be following, not only because of good governance, but because ISS and Glass Lewis closely track whether or not you have performance-based pay and how much of your pay is for performance. So I don't think that just because 162M is going away or the performance-based compensation exception is going away, that will really impact how much is discretionary and what's not discretionary. But as to your question, Mary Beth, what's happening today? Now, it's December 14th. We're almost at that, the year end, and now we're faced with the reality of what's going to happen. I mean, the first thing to note is that there is some grandfathering under this, so that I think the way, they're going back and forth about what the cutoff date is, but right now it seems that the latest is that any compensation that was payable under a binding agreement entered into on or before November 2nd, 2017, that of course hasn't been modified too much, would be grandfathered. So if you've set up a program for 2017 and maybe it pays out in 18, but you'll still get the impact of grandfathering and taking the deduction for that year. Another question that comes up is, and this is a big one, we've seen a lot of activity on this, strangely, in the past couple of days, and I'm not sure where it's coming from, but people are saying there's a new disclosure requirement. Now I have to write in my proxy the exact amounts and to what extent I've lost all my deductions because of compensation in excess of $1 million. And that's not exactly the case. Tax laws are not disclosure rules. The disclosure rules in the CD&A, you do have to talk about the impact of tax and accounting on decisions you've made. However, it doesn't specify that you have to disclose the 162M loss of deduction. A lot of people are saying now, maybe for the proxy filed not in 2018 but 2019, we'll have to talk a little bit more about this loss of deduction because it might be a little bit more material than it had before because you'll lose the performance-based pay exemption. So a lot of people are thinking about, well, how will this look in our disclosure going forward? And then, Mary Beth, to the real question that you're asking, like what can I do today and should I be accelerating payments? The answer is, for most companies, if you're talking about a bonus payout or some sort of equity payout based on performance-based pay for the 2017 performance period, to the extent that you pay out 75 days into 2018, it is still deductible by the company in 2017. So you'll still get the benefit of the rules in 2017 rather than 2018, even if you don't accelerate.
Thank you.
And then the last thing I wanted to talk about really was the elimination of AMT. ISOs, incentive stock options, are pretty beneficial to executives because if you hold it for a year after exercise and 2 years after grant, you don't get the ordinary income tax and you get the long-term capital gains. Executives love it, companies not so much because the company would lose a deduction for that same period. So very beneficial for executives, except that if you are AMT'd, you would not be allowed to reap the benefit of the ISOs, or it would put you into AMT world. And without getting into too much detail on that, under the new tax rules, there will be an elimination of the AMT. So it may, in fact, make ISOs a little bit more desirable, despite the fact that the company loses a deduction, which, as we've mentioned before, because corporate income tax rates are going down, the deduction will not be worth as much, so it might be neutralized and all else equal. So with that, I think I will turn it back. Oh, we have one polling question before we can move on. With all of this constant movement, I think a lot of compensation committees have felt a little bit stymied about what to do and haven't really been able to really focus on this. So we were going to ask you, what have you done in anticipation of the tax reform and potential implications? Have you done anything? Have you discussed it, or have you not touched it?
I think this will be a great question because a lot of times, I think boards don't talk a lot about taxes in general. So I think this will be a great question to see about this specific issue.
Right. And this one's a tough one because there's so many moving parts and so much is being negotiated that it was very hard for us to provide any advice to anybody on this because we just didn't know where it was going to end up, and we didn't want anybody to make any sudden movements that they would have to then rescind. Oh, here we go. So we see here that about a quarter of you have started to talk about it, and you've talked about it generally, mostly, but not specifically for executive compensation purposes, and then about a third of you were right where I thought a lot of you would be, which is we haven't even begun to talk about it. So that's great. Now let us move on to something that's not so technically driven and hopefully maybe a little bit more exciting for the next, for the middle part of our presentation. Sharon, I'll turn it over to you.
Thanks, Deb. I don't know about exciting. And speaking of old friends, here we are again talking about the CEO pay ratio, which, as I think most of you know, we've been talking about now for a pretty long time. It's been over 2 years since the CEO pay ratio signed into law and has been hanging over our heads. And I think most of us were hoping that it would die somewhere in D.C. with the new administration, but here we are. It's December 14th, and we are still talking about it. What we're not going to do today, since we have been talking about it for so long, is go through the rule again, but rather we thought we would use this time to talk a little bit and share a little bit about what we've been hearing over the last few weeks as companies are gearing up to create their disclosures and prepare for potential fallout after the disclosures. So what you see here, earlier this fall, Perlmeyer did its annual executive compensation planning survey. We asked over 300 companies some key questions about the CEO pay ratio. And while we're all in this together in this first year, and it's a little tricky to talk about true trends, what we did find and what you see here, not so surprisingly, is that the larger the company, the larger the expected ratio. But what's also really important to keep in mind is that pay ratios are going to be based on a number of factors, not just company size. It's going to vary on industry, stage in a company's business cycle. It'll also depend on organizational structure and how workforce is structured. So in particular, whether or not a company has temporary or seasonal or part-time workers. So that'll also play a role. And of course, if a company is global, that could impact the numbers. As what you see here, based on our findings, the expected ratio that's probably most prevalent at this point is in the 101 to 1 to 250 to 1 range. And generally speaking, we expect that if your ratio is below 250 to 1, you shouldn't worry too much, at least in this first year. And of course, this first year being the important part of that statement. So moving on, what else have we learned over the last few weeks and months as people are talking about the CEO pay ratio and preparing? We know that ISS and Glass Lewis are going to include the data in their report findings, but what we know also is that they don't intend to factor those numbers into their voting decisions at this time. Similarly, institutional investors have indicated since they'll have access to the data, they're going to pay attention to it. But like the proxy advisory firms, they're not going to use it in a material way, at least in this first year. But what remains to be seen is how the data will be used in the future. And according to ISS's most recent policy survey published this fall, 3/4 of the investor respondents indicated that they intended to compare ratios across companies or industry sectors or assess year-on-year changes in the ratio at an individual company when making their future voting and or investment decisions. As far as what the disclosure will include, we've been having a lot of discussions about, what should we disclose, how detailed should we be. At this point, I think we're comfortable to say that most companies are taking a short and sweet approach that is compliant but concise. In terms of placement of the disclosure, we're hearing consistently that it'll be towards the end of the CD&A narrative, either just before the SEC required tables or at the very end of the SEC required tables and before the next proposal section. But with all of that and with, calculations mostly final now and companies thinking about the disclosures, we can say that the focus is really starting to turn away from that and towards a broader communication planning. Specifically, companies are starting to ask what else or what should they be concerned about. In other words, what are our highest messaging risks? So is it the ratio itself? Or what kind of spotlight will the ratio put on what our CEO earns? Or how will the level of our median employee pay be received or perceived by others? Does it seem high? Does it seem low? Is it in the right spot? Answers to these questions are going to form the basis for determining what types of messages need to be prepared to successfully respond to any queries you may receive from various stakeholder groups, and in particular, your workforce. Companies are also asking what, if at all, is the right time to communicate about the CEO pay ratio, specifically to their workforce. We don't believe, we've talked about this a lot internally, is that, the CEO pay ratio should be its own internal communication campaign. In fact, communicating broadly to the workforce about what the CEO pay ratio is and why you need to disclose it is not emerging as a best practice. Rather, companies are taking this time to determine which key internal folks, whether it's in HR or line managers, should have some pre-education shortly before the filing, so they're prepared to answer any potential questions that should come up. Questions like, why do I earn less than the median employee, or why do our competitors pay their median employees more than we do, or how did you determine who the median employee is? The laundry list of questions really does go on, but at the end of the day, the objective for those who are fielding questions from the workforce should be to get employees to recognize that comparing themselves to the median employee is just not a good exercise. And comparing the median employee pay or ratios to that of other companies, even in the same industries, is also not a great idea. And that's because we know that the methodologies for coming up with the ratios, company to company, are going to be very different in most cases.
And Sharon, this is Deb. I just wanted to jump on this with one comment going back to the disclosure and the proxy, and to your point that there's no basis of comparison. While everybody is keeping their disclosure short and sweet for the most part, every single company I see is putting in a disclaimer saying, this is based on reasonable methodologies and assumptions, because there's a lot of flexibility to do so. And under no circumstances can you or should you compare this to other companies, because everybody's using a different set of facts. So we try to get it out there right in the disclosure, even before it gets to employee communications.
Yes, that's a great point. Thanks, Deb. I think that at this point in time, really, in terms of overall planning, and what you see here is just a very high-level timeline of activities that your team should be considering, assuming you're a year-end filer. Now that we're in mid-December, and final calculations should be pretty much firmed up. Drafting a CEO pay ratio narrative for your proxy can begin, with all the pretty caveats, as well as, taking the time to assess what your potential communication risks might be based on what your disclosure sounds like. And then soon thereafter, based on those risks, you can start to understand, generally who the internal stakeholders are that need to be educated, and to begin to develop the preliminary messages needed, as well as how those messages will be delivered. So, in other words, who are the people who are going to presumably sit down to explain what's happening and how to be prepared? So things like frequently asked questions, or presentation decks or talking points will be developed in the right way and delivered to the right people.
Sharon, can you speak a little bit closer to the receiver? Sometimes the sound is going in and out. Thank you.
Oh, sure. Is that better?
Yes, thank you.
Okay, great. I think ideally what we'd like to make sure is that as draft materials are being created, that at some point in February, or maybe even a little bit sooner, that those materials are being tested with leaders, potentially the board, just to ensure that any messages that are going to, be delivered to anybody are going to be consistent with what's ever being communicated in your proxy statement or otherwise. So then you can go forward and preview with other levels of management or stakeholders who should be in the know shortly before the disclosure is filed. And then after that, it's really just about educating people and monitoring what other companies are saying in their filings, as well as keeping a close watch on the news. And of course, if you end up in the spotlight, which we hope you don't, you'll want to make sure that you have a contingency plan to update your materials and make sure your messages are clear and consistent. And then
Sharon, we have a question from the audience, and the question is, what are some of the factors used to determine a median employee, and why do they differ so much from company to company?
Sharon, do you want me to take this one, since I'm like a nerd and in the weeds?
Sure, that would be great. Thanks, Deb.
So going back to the data collection part of this, under the rules, the SEC gave us a lot of flexibility to find the median employee. Finding the median employee, the entire exercise is 2 steps. First, you identify the median employee. Once you have that median employee, you run them through the summary compensation table rules as if they were a named executive officer. in an ideal world, you would take your entire population and do that, find out what their summary compensation table data would be, and find a middle person. But the SEC realizes that that's impractical for large corporations, and so they allow you to find a proxy for that number. And the way that you find that is to find what they call a consistently applied compensation measure. For most companies, if most companies have base salary. Most companies have, for most of their population, some sort of bonus or incentive. And most companies, except in high tech areas, they provide equity, but only at the top levels. So for most companies, we're finding that the sum of base and bonus is that measure you can use to identify the median employee. For high-tech companies where maybe equity is widely distributed, you would include the grant date value of equity. For some companies, it's really quite simple. If they're, for example, domestic and you have you have W-2 information on them, you can simply take W-2 and find the median person. So companies are all over the place about what they're doing. There are other assumptions you could take. You could apply cost of living adjustments. You could exclude up to 5% of your workforce overseas. You're allowed to annualize those employees who are only working for you part of the year. But all of these rules are permission to do so and not must do so. So some companies might be annualizing, some companies might not. Some companies might exclude or apply a cost of living adjustment, and some companies may not. So it's very difficult without a rigid set of rules to do a peer-to-peer comparison of where the median person is, what that person makes, and what the ratio is.
Sharon or Deb, we have another audience question, and this is, does a smaller reporting company need to do the pay ratio?
The answer to that...
Go ahead.
I was going to say, I think they're one of the lucky ones, right, Deb?
Right.
They're an exception. Did that answer the
That was an audience
question?
question. Yeah, we can move on.
Okay. And I'm going to wrap this up. I think, at the end of the day, what we want to make sure is that we know this is a lot of work to do in a short period of time, and, developing the messages and, being prepared to answer questions from your workforce about compensation, hopefully can be leveraged longer term. We believe that a lot of the messages and the real objective is to make sure that employees understand that when they look at the median employee pay, or they hear about the median employee pay at their own company, that it's clear that they can't make an apples-to-apples comparison, because it's likely that that person is doing a very different job in a different place with different experience. And so it gets back to sort of the fundamentals of having your population, your workforce understand your compensation philosophy, et cetera. So with that, I think we have another polling question that's going to segue us into the ISS and Glass Lewis voting policies. But has the CEO pay ratio issue led to a discussion of gender pay equity on your board? And so we've got a yes or a no. It'll be interesting to see
I think
what people have to say here.
I think this will be a good one to see the results, mainly if you look at all the issues that have been going on in the news. I think this is going to be very telling to see what we see.
Sharon, going back to the CEO pay ratio and the impact on ISS and Glass Lewis, although they're not reporting them in, it's not going to be a determining factor in making recommendations. It was kind of interesting because ISS stirred the pot when it put the question out there in its policy survey, and we had an inordinate number of responses saying they're paying attention, investors saying they will be paying attention to the ratio, but we really don't understand how they will or what they will be doing because now ISS won't be doing it. And when you reach out to these individual investors, they kind of said, well, we're going to look at it, but we're not basing voting results on it.
Right.
I digress, but back to, looks like we have some answers here.
It looks like we've got almost 3/4 saying no and a little bit over a quarter saying yes.
And I wonder whether that is really reflective of why the pay ratio is less for, we're not talking about it at the board level. I think that's really indicative of it because the pay, I'm not sure what the number is now, but it's probably, in the upper 70s, low 80s in terms of the gender versus females versus males. So, and maybe that elevating it to the board level may have an impact.
All right.
All right, Deb.
Well, great. On to net neutrality. No, just kidding. Nothing quite that exciting. We are talking now about the influence and the voting policies of our friends ISS and Glass Lewis, key proxy advisors that make recommendations to institutional investors on a variety of things put in the ballot on the proxy. And this year, happy to say, in light of all these other things that are going on at this time, ISS and Glass Lewis were relatively quiet, not really big changes for this year, which is a welcome relief for board members because there's just been so much activity on other items, particularly the CEO pay ratio. So ISS, they start out a process every year. They issue a policy, they issue a survey where institutional investors and companies and consultants could write in and express opinions on different topics, and that survey comes out in August, and then the results come out in September. They draft a proposal of proposed changes, and then they finalize. And subsequent to the finalization, which it usually happens right before Thanksgiving or following that, we get some FAQs, and then we'll get a final policy in January. But all of these policies will be applicable to those companies filing on or after February 1st, which is most companies. So what do we have for this year? This year, one of the big changes was changing or tweaking the pay for performance methodology. As you will recall, prior to last year, ISS was using TSR as the sole financial measure in its quantitative pay for performance screen. And it was looking at the relative degree of alignment, which is a test that compares the percentile ranks of a company's 3-year average CEO pay and 3-year annualized TSR with those of certain peers determined by ISS. And so there's been a lot of criticism, a lot of analysis about whether or not TSR is a good indicator of company performance, and company performance long term. And so as a result of that, ISS sort of backed away from the pure TSR related test and said, okay, we'll look at financial metrics, not solely TSR. And in particular, they were thinking about 6 financial metrics, which were return on equity, return on assets, return on investable capital, revenue growth, growth in earnings before taxes, and operating cash flow. And they said, we'll take into account these 6 factors. However, it's going to be on a qualitative basis, not a quantitative basis. Well, that was great. We saw an analysis of this in last year's proxy reports last year's ISS reports issued, where it was qualitative, and maybe it could move the needle a little bit if you were on the verge or on the edge for your quantitative test. Well, this year they said they will now take these financial measures into consideration if you're on the verge on your quantitative test. And so what they did was provide a chart that showed which measures would be considered, and they vary by GICS code. What ISS didn't tell us, and what's typical for ISS, is they don't tell us how it's going to be taken into consideration, how it's going to be weighted, and how it's going to move the needle. So we're, again, sort of in this land of non-transparency where all you could do is guess where you're going to wind up unless you choose to work with ISS and you purchase their model and you work with them. So you should just be aware that this will come into effect for your quantitative tests in 2018. Another piece that's sort of interesting but really doesn't have too much of an impact. In previous years, if your company received less than 70% on their say on pay, ISS was really looking for a heightened level of shareholder engagement, and they also said, you issuer, you describe to us, tell us what that engagement was, and we want to see it to be pretty rigorous for us to make a recommendation in favor of you after you lost your vote by so much in the prior year. This year, they codified it a little bit, and they said, not only do you have to do this, but we also want more disclosure. We want you to tell us the timing and frequency of your engagement, whether your independent directors participated. We want to know whether or not you addressed all of the concerns raised by shareholders that you solicited and that you talked to about the low voting outcome. And also tell us about the meaningful actions taken by you to address shareholder concerns. And it's kind of funny because, Sharon, you write a lot of proxies too. What we've seen is sort of this evolution of a chart in the proxy that talks about how many shareholders we solicited, what the issue is, and what we did to address that issue.
It's sort of emerging too as it's shifting. I think what we're seeing in terms of a best practice executive summary structure, and most recently over the last couple of weeks have starting to really get busy in this space. And companies that are dealing with this have kind of taken a step back from leading their CD&A with their business results, but rather talking about what's happened over the past year with respect to their shareholder outreach and efforts to respond.
Great. Speaking of say on pay, this is a weird one because apparently there were a lot of companies that forgot to submit their say on frequency, put say on frequency on the ballot this year. As you recall, say on pay went into effect around 2011, and in 2011 you had a say on pay vote and a say on frequency vote. On the say on frequency vote, shareholders get to decide whether the say on pay occurs every 1, 2, or 3 years. And then you have to put the say on frequency vote back to shareholders every 6 years. Well, fast forward 6 years, everybody was talking about the say on frequency last year, and it was sort of a hot topic, but some companies failed to put it to shareholders, and I guess ISS picked up on this, and they said, that's a problematic pay practice, don't do that. And also, if you fail to provide the say on pay vote, even though you said you would and you have to, that's also a problematic pay practice. Go figure. Moving on to pledging, under Dodd-Frank, there was a lot of talk about hedging and prohibiting hedging, and companies went back and they looked at their hedging policies, and then ISS and Glass Lewis jumped on and they said, well, you should have some sort of hedging and pledging policy. And for the most part, most companies do have a policy prohibiting hedging and pledging, and a lot of it is embedded in their insider trading or 10B programs. But ISS essentially codified this year. They said they'll be looking on a case-by-case basis about whether or not there's a prohibition on pledging of company shares. To see what the magnitude is. There are some companies, I will say, almost every company I've worked with has an anti-hedging policy. Some companies don't want to commit to a full-on pledging policy because executives might want to have the ability to sell pledge shares rather than sell them, especially if they're heavily invested in the company's stock. So there are some reasons not to have a full-on pledging policy, but as you'll see here, ISS now has codified what they're looking for and when they'll vote against members of the committee responsible for oversight if it's failure in governance. The next one might be a little bit more exciting to all of you, which is ISS is now considering a vote against board and committee members responsible for approving your compensation, director compensation, when there's a recurring pattern, so 2 years or more of what they call excessive non-executive director pay without a compelling rationale or mitigating factors. The problem with all of this is there's no definition about what a compelling rationale is, a mitigating factor is, or what is excessive. All we know is that they say it's an extreme outlier compared to peers. We know it when we see it. And, fortunately, it's not going to impact voting results until 2019 because we're going to need to see this excessive pattern and practice for 2 years. So in 2019, we'll know a little bit more about what this means.
I think, Deb, this really makes it difficult for board members when we are, deciding what our pay is to keep it in, to pass the red face test. But I think this is a difficult one when you have little guidance from them on that of what they think is excessive, et cetera.
Right. I mean, I agree with you, but to be honest with you, in the past 3 or 4 years, people have really focused in on non-employee director compensation in light of a lot of the shareholder actions we've seen claiming excessive director pay. The Citrix case kind of set that in motion, and we've had various lawsuits following that. And so what I see now is when equity plans are approved by companies, they're not only putting in a sublimit on the number of equity awards that can be made to directors in a year, they're also going above and beyond, and they're saying, we'll never pay total compensation to directors above X. And when we talk to companies about what X should be, you look at you benchmark it, you look at peers, and you look at what has historically been paid and what it means in terms of market volatility. And, you put in a number you don't think you'd ever achieve, yet is reasonable. We talked a little bit about gender pay gap proposals. And this is an interesting one because if you will recall, under the Obama administration, there was going to be a mandate to report gender pay broken out a little bit more specifically by the EEOC, and that was supposed to go into effect for the first report issued in April. That has since been rescinded, so people are once again focusing on, well, how can I get this information? And so what ISS has said is that if there's a proposal requesting reporting of pay data, ISS will vote on a case-by-case basis, and it depends on what the company already has out there, whether they're subject to recent controversies and litigation with respect to gender pay, and whether the disclosure of the peers is better than the company that has received the shareholder proposal. So that is a hot topic, and it will continue to be a hot topic lately.
Deb, we have an audience question, and the question is, I understand that DoddFrank/ISS all apply to public companies. Is there a similar requirement for private companies?
I'm sorry, is it Dodd-Frank or?
Well, the question deals with, they put both Dodd-Frank and ISS. So obviously ISS ruling goes toward public companies, but does any of the Dodd-Frank rulings when it comes to compensation apply to private companies?
They don't specifically apply. Most of the provisions that we're talking about under Dodd-Frank and certainly ISS apply to public companies, but usually that sets the tone, and then there's some cascading down into private company world, particularly if a private company is on the verge of or considering going public. So it's it sets the tone for best practice, even though it's not directly applicable.
Great, thank you.
Sure. Moving on, there's been a couple of tweaks, again, back to the pay for performance test. This was kind of obvious, but the TSR calculation used to be point-to-point, so that if there was a big dip in TSR on your end date because of a blip in some sort of, analyst prediction or news or, something in the media, you'd really have a big problem with aligning TSR. And so the ISS said, when we look at TSR, we'll smooth it and we'll take an average over the beginning and ending stock price. Also, multiple median test, which is another tweak in the pay for performance test, has been changed. And as we mentioned before, the financial performance assessment is a secondary screen on the traditional TSR-driven pay for performance test. Something we spoke about earlier, when you submit an equity plan to shareholders, which we have had to do under the exchanges since the early 2000s, You hope your shareholders approve it so that you could issue equity. Otherwise, you have no equity to give out, except there's limited exceptions. But ISS makes a recommendation on whether or not shareholders should approve the plan. And there's certain passing scores. The passing score went up a little bit this year. One of the most important things that you can get points on or not get points on is the change in control feature in your equity plan. And this year, it was a little bit not that translucent. It was not that transparent how to get points on this in the past few years, but ISS got a little bit more clear. And so this year, in order to get full points on the change of control feature, for time-based awards, you can't have an automatic acceleration. So in other words, upon a change of control, if you keep your job, you can't automatically accelerate those time-based awards. For performance-based awards, you can only have, upon change of control, vesting based on pro rata or actual achievement. So that's a big change, and companies are really considering whether they need those additional points, because taking away the board's ability to accelerate or maybe vest up at a different rate really strips them of convenient tools during a transaction process. There's other things that the ISS has clarified in the equity scorecard, but you can read those, and we should probably move on to a couple of things that ISS has not addressed, which are the CEO pay ratio, as I mentioned earlier. They kind of stirred the pot, and we all got excited that investors seem to be interested in that, and at the end of the day, ISS said, we can't really do anything with this. We'll put it in our report, but we're not going to use it for any recommendations. That's for 2018. For 2019, all bets are off the table because we'll have a whole bunch of peers to compare you to. And then we were all talking about whether realizable pay, not just grant date fair value pay in the summary compensation table, will now be a factor. ISS has sort of tabled that, even though many of us still continue to include a discussion of realizable pay in our proxies. Turning over to Glass Lewis, which has an impact on some companies, clearly not as wide and vast as ISS. They put out a couple of new policies as well this year. They, like ISS, said that the CEO pay ratio information will be in the reports, but will not be the basis of recommendation. Glass Lewis is not as transparent, even less transparent than ISS on their pay for performance test. If you've ever looked at a Glass Lewis report, what they do is produce a fairway result of where your pay and performance align, and it's ranked A, B, C, D, E. And for most of us that are type A and overachievers, we think that an A rating is the best, but really you want to have a C rating because C means your pay and performance are aligned. If you have an A rating, it means that your CEO pay is really low compared to your performance, and that might not be where you want to be for obvious reasons. Similarly, Glass Lewis is looking at not only gender issues in the workforce, but board gender diversity, and they have put out something very important, which says that in 2019, they will generally recommend against the NomGov committee if a board has no female members. So important to look at what the membership of your board is going forward if you haven't already addressed diversity and gender issues. They have tweaked the overboarding policy a little bit. It's going to be a little bit qualitative and a look at the roles and the duties and the responsibilities to assess whether or not they consider a board to be, a specific director to be overboarded. And then they have a few things that sort of fall outside of the executive compensation arena, but we provided it here for you, and if we boil it down, they are going to give special scrutiny to those companies that now have a dual class share structure, which most of the advisors consider to be not great practice, and they'll also take a closer look where there are only virtual shareholder meetings, which a lot of companies are turning to now, particularly if the company doesn't provide disclosure that it's going to be virtual only. And that is a very, very fast wrap on the proxy advisory scene, and we have time for a few questions now.
Yes, we had one audience question that came through earlier, and it goes back to the pay ratio section. And this is, what is a company's size for the exception to not have to do the calculation of the ratio. I know we had a question about whether you need to do it or not, but if you're smaller reporting. But what is that size is this particular question asking? I'll turn it to either Deb or Sharon to answer.
Right. The determination of whether you're a smaller reporting company, one type of entity that's exempt from the pay ratio rule is it's being relooked at, and there's been some proposals to raise a limit, but I think currently you look at whether at the end of your second quarter you have a public float of greater than 75 million.
Okay. And then another question that came up, and this is going back to executive comp, it says to clarify the $1 million exemption, does it apply to all executive comp or only to the performance-based component?
So a company gets a deduction for expenses. Compensation is an expense. What 162M does is it says for proxy officers, you're only allowed to deduct up to $1 million, except to the extent that something is performance-based. Some companies don't pay their proxy officers. They might be below $1 million all in. So everything is deductible, whether or not it's performance-based. However, once you get above $1 million, you can only deduct more than the $1 million to the extent that it's performance-based. So for base pay, for example, you'll see a lot of executives capped at $1 million because that's fixed and it will never be performance-based. If you have a base salary of $1.1 million, that means $100,000 will never be deductible. You'd be better off having $1 million of salary and then $100,000 that meets the 162M performance-based exception, and then you can deduct the entire $1.1 million until 2018, and then you lose that.
And I think there's one last question here. Is there anything included in the reform plan that addresses significant changes to the allowance of the NQDC plans?
Non-qualified deferred compensation. Thank you. Yes, I specifically excluded that because it gave me so much heartburn when it was in the proposal that I really almost had to change professions. Very quickly, I think in the one of the earlier versions of one of the bills, the Congress had suggested eliminating Code Section 409A, which was a giant piece of legislation put in place in 2007 that really dictated the very specific parameters for the ability for executives to defer compensation. So maybe something vests now, but you don't take tax and you don't receive it until later. And the overhaul would have gotten rid of all of 409A, put in place 409B, which really didn't allow executives to take any deferrals, would have made stock options taxable upon vesting. It was a big nightmare and a hairy mess. And after a bunch of going back and forth, they eliminated that change. So we're back to 409A being intact and being the big hairy mess that it was and always is and that we love.
Well, that is all the audience questions that had come through the council here. But if any of you on the call have additional questions,